Hey guys, welcome back to the channel. Today we're going to look at rolling my Apple covered call onto next week and possibly reducing the strike price that we're going to go for. I've built this new spreadsheet that is going to help me decide, and I really want to show you guys that. Also, as you can see, I did sell a put on Bank of America earlier this week. And I have been experimenting with some iron condors too. I've set up an iron condor on Pepsi and Walmart. They're pretty stable stocks. This is the first time I've done them, so I just kind of want to check it out for myself before I start making videos on iron condors and other types of spreads. So I just wanted to mention it and quickly show you. The main focus of today is we're going to roll this Apple covered call. So I want to show you this spreadsheet that I've sort of designed to help me track the wheel strategy. So it's still a work in progress, but basically you type in the ticker, it'll automatically pull the company name and the current price of the stock in. I've got some conditional formatting on this, so the reason it's showing red is because it's currently below my cost basis. If it was above my cost basis, it would be green, because obviously, ideally we want to be above the cost basis when we're selling covered calls, so we can maximize our gains. But I've been in this situation where I got assigned at a pretty high price, and I've been tracking my way down. So, like I say, we have the current price in this box, strike price that I was assigned at, which was the 128.75. The total premiums I've gained so far from this trade. Obviously, I made a loss as well, so that's why we're not above where I started this mess from. My current cost basis, which is the premiums minus the strike price. There is a dividend column here too, but I haven't received any yet while holding this stock. And then there's a running profit and loss, which is, basically the $12,875 I paid to get into this trade. And my current total profit is technically minus $12,600, because that's the total premiums minus what I paid. But obviously, if I get these shares called away, I'll gain whatever dollar amount back, and you'll see in a second when we plug in some numbers how that can affect us. So just going through it quickly, I sold a cash secure put in the first place at the 128, got $305 for that, and that's where I was assigned. And since then, I sold this put credit spread, which I got $15 for, which went disastrously, and I had to buy to close for $98, so I made a $98 loss there. And then since then, we've been more conservative selling covered calls. We made $8 and $45 as the prices come up. The current price being $115, we're pretty far from our cost basis. So, I want to look at the chart real quick, see what's going on. Again, Apple seems to keep sort of selling off, rebounding. They do have earnings coming up next week. I don't know at the moment whether I should sort of sell a covered call at my cost basis. So, if I get out of this trade, it's pretty much like with minimal profit, or, still try and sort of keep the amount up. If the price does rocket after earnings and the shares get called away, I sort of make max profit. I mean, let me know in the comments below if you think, I should be selling at cost basis, or you think, I'm right to sort of play it a bit slower and try and wait for the price to come back up to me, and I can sort of make max profit. My thinking is that obviously if I get out of the trade and get my collateral back, I can start wheeling something else and start generating some more money, as opposed to just waiting on, this Apple price. I mean, it has to come all the way up to sort of this kind of level for me to break even. And as you can see, we're right down here right now. Obviously, the portfolio is still down. We're at 1450. We've made some money this week, wheeling, selling a cash secure put on Bank of America and these two iron condors. But it's been a bit slow progress. So on one hand, you know, I'm playing it safe. I'm holding 100 shares of Apple, which is a really great company. And, you know, long term, like I imagine the share price is going to go like way up. I just kind of want to get to a position where, you know, I start generating more income, because ideally I want to make like between $100 and sort of $200 a week. So I can start like generating this money to get to doing the spy wheel, which is like the whole point of this channel, is to generate more and more money until we can sort of run that spy wheel and like really make those big sort of passive income gains. So if we look at the price of Apple right now, we're at like 115.50. I can, where is it? I can buy to close this contract now for $1. If we look at the options chain, I can roll it out to next week at the $130 call where I'm at right now. I'd make $38. So let's plug that into this calculator and just see where we're at. Okay, so if we select covered call, we choose today's date. The strike price we're looking at currently is 130, and the premium was 38 cents, and we can only do one contract because we only have 100 shares. You can see that would bring my cost basis down to 152.62. If I was to get the shares called away at that price, you know, we'd get back $13,000. We'd have the 125 that we made over the existing amount we paid for the shares in the first place, plus the premium. So our total profit, if our shares got called away at 130 right now, would be $438, which, you know, is pretty decent. But the share price is $115 right now, and is it going to get to 130 by next week just on earnings? I don't think so. I mean, I pretty much, you know, I'm not an expert, but I'm guessing that a lot of people are suspecting that Apple's going to, you know, beat its earnings. They've got the iPhone 12 coming up, but I don't think it's going to be enough to run the stock price up sort of $15 in the matter of a week. I mean, I may be wrong, but you know, that's why I'm not going to sell below my cost basis of 126, but because I want to make some money. I don't want to like finish this, especially considering the length of time I've been in this trade, at a loss. So, I mean, if I was to roll out for the 130 and didn't get assigned, like we'd still be at sort of 13 in premiums. But we know, let's plug in some other numbers and just check it out. So let me just back this up. So if we were to do the sort of 126, which is our cost basis right now, we'd get 74 cents. So let's hit that in. 126. We get 74 cents through the one contract. That would bring our cost basis down to 125.26. But obviously, you know, if the share price does go up after earnings and they get called away at that price, we'd only get back $12,600. So, you know, we'd be down $275 on what we actually originally paid for them. But if you take into account the premiums, we'd come out of this trade with a $74 profit in like 2 months, which is not a lot of money for 8 weeks. But this trade in particular has definitely taught me a ton about wheeling options. So this is why, like, I built this this spreadsheet to track it. And I think what I'll do is, when I'm happy with it and you know, I've ironed out some of the little problems I've got with some of the formulas, I'm gonna like give this away to you guys. And if you want to use it yourselves to track your trades, you definitely can. I think it's like really helpful to make these kind of decisions on where to go, and it's pretty easy. Like, I've set it up to be as automated as possible right now. If you've got any ideas on the spreadsheet that you see, obviously let me know in the comments below. Like, together, you know, we can obviously make it the best we can, and you know, I want it to sort of help as many people as I can. So this is where we're at. We could look at going sort of in the middle at the sort of 128, get 53. cents, and if we were to get called away by there, we would make 253. It's really hard to decide whether to just sort of try and maximize the amount of premiums that we're going to go for, bet that we're not going to come up to the sort of strike price and the shares are not going to get called away. I mean, I think looking at it, if we go $130, you know, that's the best, but I'm not going to generate that much money. So these are the things you have to think about. I kind of want out of this trade, so I'm thinking I'm going to do the 126 strike price. That way, you know, if we don't get the shares called away at that price, you know, we make more money. And then, you know, the week after, when it's a bit more stable, you know, I can really look to chase this price down and get into the sort of, you know, hundreds of dollars. Like you can see, if we were $2 away from the share price, you know, I could be generating $300 a week on these covered calls. And that's where I want to get to. So I think the only way to do that realistically is to, you know, drive this price down as quick as we can. And that's literally going to be to roll these covered calls down every week until they get called away, or, you know, that we can play the game and just sort of stay above it as we come up in price until we were back above the 128.75. So I think let's just do that. So let's plug it in one more time so we can see it. 126 is going to get us like 73. So we'll do 26. We'll probably aim for 75. The price has been fluctuating. And let's hope our shares don't get called away. So we'll just delete that cell for now. That will bring our cost basis down to 125. So I guess the following week we can just do the 125 strike price, because the amount of premiums will drop it down below that. We can look at that next week. But let's go ahead and first off look to buy to close. So we'll pay $1 for this, which actually brings me back to this point. If we have to change this because we're going to buy to close that position at the 130. Sorry, that was 130. Strike price, which we originally paid. I'm going to pay back $1 for this by the look. Yeah, so 1 penny, but it's 100 shares, so it'll be $1. And that will show as a debit and you know, increase our cost basis by a penny, but you know, that's no problem. We won't get a sign there, obviously. So let's first off close that. So when you go to either close a cash secure put or close a covered call, you do the opposite. So I sold a covered call, so now I have to buy it back to close it. So obviously I was paid $45 to open it, and now I'm only paying a penny to close it. So we're basically at max profit, 98% of that trade. So let's plug in our 1 penny there, and hopefully that will get closed straight away. I'm gonna love the two-factor authentication. I mean, you should all be using it because, you know, Robinhood did get hacked recently. I know like 2FA isn't the most secure thing, but like, let's try and be as safe as we can, guys. So we've pushed that through, and I think that just executed. No, it's waiting. So we'll just wait a couple of seconds and you know, hope that goes through pretty quickly. In the meantime, we can prepare. Oh, there it goes. It just went through. So we just bought to close and got our 100 shares back. So now we can sell this next covered call. So again, we'll pull up the options chain, make sure we're on sell and call, because we're selling a covered call on our 100 shares. We'll pick the 30th, which is the week after. You know, you can see underneath on Robinhood here that you know, the earnings are expected on October 29th after hours, which is Thursday night. So, you know, it's only going to have the 1 day to push up to hit my strike price if these get called away. So I'm not terribly worried about losing my shares at 126. I got a gut feeling we're not going to get there, but, you know, I'm not usually right. So we'll see how it goes. Okay, so sell call. We're going out to the 30th. I've decided to do the $126 strike price, and as you can see, it's at 75, which is going to be the mid price. So we're going to pick that, hit continue. We're going to do one contract because we have 100 shares. We'll leave it at the 0.75, and let's just review that order. Again, like normal, we are going to sell 100 shares of Apple at 126 on or before October 30th. So that's what we want to do. We're going to hit submit right there. And that is done. Let's see if it hit the account already. That's still pending. 1 second. So let's just make sure we've got this spreadsheet up to date. So we bought to close, and now we're selling another covered call. Today we did the 126 strike, and we're aiming for 75 cents a share. One contract, and that will bring us down to 125.26 for our new cost basis the week after. We were at the $350 in premiums, and you know, our total profit has been reduced a little. Like, I'm pretty much expecting this share price to bounce off this sort of level that it's hit previously, and then, you know, during earnings or on the run up to earnings, it'll push up a bit. So I think we're going to do okay. As you can see right there, it already filled at the 75 and has gone up 1 penny. But, you know, I think for where we're at right now with the account, you can see that the money already hit the account too. So we made that $75 today. And when this Bank of America put closes tomorrow, we will release another $2,400 back into the account, and we can look to wheel something else. I may wheel another Bank of America put or AT&T, see which one's got the best premiums next week. But that's pretty much all I wanted to show you today. I just wanted to show you like how you roll a covered call. I wanted to show you this new spreadsheet that I've developed, and you know, try and get your guys' input. Hopefully you think it's a good idea to give this away, and you know, people will get some use out of it. Other than that, you know, we're at 96 subscribers. We're 4 away from that first milestone of 100 subscribers. I really appreciate everyone that's joined the journey so far. And I guess until next time, I hope you all make some money and have a good weekend.